Ever considered investing in stocks but got intimidated by the complex jargon and numbers? You're not alone. Welcome to our deep dive into the art of stock evaluation. This essential skill is the backbone of successful stock market investment, yet it's often shrouded in mystery and misconceptions. Many people fear the stock market, picturing it as a risky gamble filled with complicated charts and indecipherable terms. But what if we told you it's more akin to a game of chess, where strategy, knowledge, and a keen eye for detail can tilt the odds in your favor? Today, we're going to debunk some common myths, address your fears, and most importantly, equip you with the knowledge to evaluate stocks like a pro. So hold on to your hats, folks, it's time to demystify the world of stocks. Join us in this journey as we unravel the secrets of stock evaluation. Before diving into stock evaluation, let's get clear on what a stock is. Picture this. You're at your favorite pizza place, and they offer you a slice of the business, quite literally. Buying a stock is much like buying a slice of a company's pizza. It's a piece of the company's value, its assets, and its future earnings. As a stockholder, you're a part owner of that company, and that slice could potentially grow in value, just like a thriving pizza place might expand and increase its profits. However, it's not all pepperoni and cheese. Investing in stocks also comes with risks. Just like your pizza place might face competition, your company's stock could decrease in value due to various factors like poor management, stiff competition, or economic downturns. The beauty of stocks is this balance of potential rewards and risks. It's about finding those golden slices in a vast pizza world, confident they'll grow into whole pies over time. Now that we are clear on what a stock is, let's move on to how to evaluate one. So, how do you determine if a stock is a good buy or not? Well, evaluating stocks is a bit like being a detective. You'll need to sift through a company's financial data to find clues about its potential future performance. But don't worry, we're not talking about anything as complex as forensic accounting here. Just a few key metrics can provide a pretty good picture of a company's financial health. First up, we have the price-to-earnings ratio, often shortened to PE ratio. This ratio tells you how much you'd have to spend to make $1 in earnings. If a company has a PE ratio of 15, for example, you'd have to invest $15 to make $1. In general, a lower PE ratio could mean the stock is undervalued, or it could mean the company is not expected to grow much in the future. Next, we have the dividend yield. This is the percentage of a company's stock price that it pays out in dividends each year. If a company has a high dividend yield, it means they're returning a good chunk of their profits back to shareholders. But be careful, a high dividend yield could also mean the company doesn't have better ways to use its profits, like investing in growth. Finally, we have market capitalization or market cap. This is simply the total value of all of a company's outstanding shares. It's a quick way to gauge a company's size relative to its competitors. Larger companies tend to be more stable, but smaller companies can offer higher growth potential. Remember, these are just tools to help you make informed decisions. They are not foolproof, and they do not guarantee success. It's important to consider other factors such as the company's business model, industry trends, and broader economic conditions. These metrics provide a snapshot of a company's financial health and can help guide your investment decisions. But stock evaluation isn't just about crunching numbers. Sure, the financials are important. They can give you a snapshot of a company's health and potential for growth, but they are just one piece of a much larger puzzle. Consider the company's business model, for instance. Is it sustainable? Does it have a competitive edge? A company with a solid business model can weather economic downturns and capitalize on upswings. It's like having a strong foundation for a house. It can withstand storms and you can always build upon it. Then there's the industry trends. Is the company operating in a growing market or a shrinking one? Is it keeping up with the latest developments, or is it being left behind? Imagine you're on a moving train. You'd want to be on a train that's going towards a bustling city, not one that's heading towards a ghost town. And let's not forget about the management team. Do they have a proven track record? Are they visionary leaders, or are they just maintaining the status quo? Think of them as the captains of a ship. You'd want someone who can navigate through treacherous waters and lead the crew towards the promised land. So you see, when it comes to stock evaluation, it's not just about the numbers. It's about understanding the bigger picture. It's about assessing the company's overall potential. A holistic approach to stock evaluation involves both quantitative and qualitative analysis. It's like putting together a jigsaw puzzle. You need all the pieces to see the complete picture, and once you do, you'll be better equipped to make informed investment decisions. Even seasoned investors can fall into traps when evaluating stocks. It's a truth that's as old as Wall Street itself. So let's dive into some of the common mistakes people make when assessing the potential of a stock. First up is the all-too-common error of focusing solely on past performance. It's easy to be lured into a sense of security by a stock's impressive track record, but remember, past performance is not an indicator of future results. The stock market is a dynamic beast, always changing, always evolving. Companies rise and fall, economies fluctuate, and unforeseen events can drastically affect a stock's performance. So, while past performance can provide useful insights, it shouldn't be your only consideration. Next, we have the pitfall of getting swayed by market hype. The stock market is often a frenzy of noise and excitement, with hot tips and insider information flying around like confetti. But, as alluring as the buzz can be, it's essential to remain level-headed. Remember, the stock market is not a popularity contest. A trending stock isn't necessarily a good investment. Instead, it's crucial to do your own research, analyze the fundamentals, and make informed decisions based on solid data, not hearsay. Another common mistake is failing to diversify. It's easy to fall in love with a particular sector or company, but putting all your eggs in one basket is a risky strategy. Diversification helps to spread the risk and can provide a safety net when certain stocks or sectors falter. Lastly, many investors overlook the importance of patience. The stock market isn't a get-rich-quick scheme. Successful investing requires time, patience, and a long-term perspective. Quick decisions often lead to mistakes, so take your time, do your homework, and remember, the tortoise won the race, not the hare. Avoiding these common mistakes can greatly improve your chances of successful stock investment. So, keep these pitfalls in mind, and you'll be well on your way to making smarter, more informed investment decisions. Fortunately, you don't have to do all the heavy lifting yourself when evaluating stocks. There's a host of tools and resources that can lend a helping hand, making your journey through the stock market a little less daunting. Let's start by talking about financial news websites. These are treasure troves of information, providing a constant stream of news and insights about companies and markets. Websites like Bloomberg, Reuters, and CNBC offer articles, interviews, and analysis that can help you understand a company's current situation and potential future trajectory. But we live in a digital age, don't we? So, let's talk about investment apps. These handy little companions not only allow you to trade stocks but also provide a wealth of information. Features may include real-time price updates, company financials, and even analyst ratings. Some apps, like Yahoo Finance and Robinhood, even offer portfolio tracking and market news. They are like your personal financial advisor right in your pocket. Now, onto analyst reports. These are detailed documents created by financial analysts who have done the deep dive into a company's operations and financials. They often include recommendations on whether to buy, hold, or sell a stock. While it's essential not to rely solely on these reports, they can provide valuable insights that you might not have considered. And let's not forget about financial ratios. These are mathematical comparisons of various financial elements, like price to earnings and debt to equity ratios. These ratios can give you a quick snapshot of a company's financial health and performance. Remember, the goal isn't to replace your own analysis with these tools, but to supplement it. Each tool provides a different perspective, and together they can help paint a more complete picture of a stock's potential. Leveraging these tools can make the stock evaluation process more efficient and informed. Like any skill, mastering stock evaluation takes practice. Just as a musician doesn't become a virtuoso overnight, you can't expect to become a stock market savant without investing time and effort. It's not about plunging headfirst into the deep end of the stock pool. Instead, it's about dipping your toes into the shallow end and gradually wading in deeper as you get comfortable. Start off with small, manageable investments. It's like learning to ride a bicycle. You'll probably start with training wheels, and there's no shame in that. Small investments allow you to learn the ropes without risking too much. It gives you a taste of the stock market, its ebbs and flows, the highs of a well-performing stock, and the lows of one that's not doing so well. But remember, it's not just about investing and hoping for the best. It's about continuous learning. The stock market is a dynamic creature. It changes with each passing second. So staying updated on market trends is crucial. Read up on financial news, listen to podcasts, join online forums, enroll in courses if you have to. The point is to keep learning, and while you're at it, don't forget to learn from your own experiences. Each investment you make, whether it's a hit or a miss, is a lesson in itself. Keep track of your decisions and their outcomes. This self-evaluation will help you understand your investing style, your strengths and weaknesses, and areas you need to work on. So keep practicing, keep learning, and most importantly, have patience. The stock market isn't a get-rich-quick scheme, it's a marathon, not a sprint. And like any marathon, it requires endurance, strategy, and a steady pace. With practice and patience, you can become adept at stock evaluation and make informed investment decisions. Remember, Rome wasn't built in a day. Similarly, your stock market prowess won't be built overnight, but with consistency and perseverance, you'll get there. And when you do, it'll be worth the journey. So, there you have it, a beginner's guide to evaluating stocks. We have traversed the path from understanding what a stock is, to the art of stock evaluation. We've unpacked the basics, dove deep beyond the numbers, and highlighted common mistakes that investors often make. In our quest of mastering this art, we've also discovered a toolbox of resources to aid us in our journey. Remember, just like any skill, practice makes perfect. The more you delve into the world of stocks, the more proficient you will become in understanding and evaluating them. Stock evaluation is not just a skill, it's an art. It's a journey where each step, each decision, each risk, and each reward shapes your investment portfolio and ultimately, your wealth. It's an ongoing process that requires diligence, patience, and continuous learning. But remember, the real magic happens when you take what you've learned and put it into action. It's time to step up, put on your analyst hat, and start evaluating. Start making informed decisions, start investing, and start growing your wealth. Remember, the key to successful stock investment lies in diligent and informed evaluation. So, start analyzing, start investing, and start growing your wealth. And don't forget to subscribe to our channel for more investing tips and insights. Thank you for watching.